Welcome to the Deep Dive. We're here to cut through the noise and give you the crucial insights you need. And today, we're putting a real Wall Street giant under the microscope, Morgan Stanley, ticker MS, our mission. To figure out, can this 90-year-old powerhouse really adapt and lead in this AI era? Or is its legacy maybe becoming a bit of a burden? We're looking at the data as of September 18th, 2025. Share price is $157.41.
And like always, we're sticking to our value investing principles, really focusing on the fundamentals, the intrinsic value. And what we found is, well, it's quite compelling. Morgan Stanley, no doubt it's a high-quality business, a really good one. But, and this is the hook, our intrinsic value model is showing a pretty significant difference from where it's trading right now. It points to potentially a lack of margin of safety at this valuation. And we'll definitely unpack why as we go.
Okay, that's definitely a hook. So how are we breaking this down for you today? First half, we'll hit Chapter 1, business analysis, then Chapter 2, management evaluation, and wrap up Part 1 with Chapter 3, financial analysis. After that, second half, we'll explore Chapter 4, market sentiment, look at Chapter 5, ownership structure, dive into Chapter 6, risk assessment, and then finally, bring it all home in Chapter 7. Conclusion. Let's jump right in.
All right, let's kick things off. We need to really get under the hood of Morgan Stanley's operations, starting with Chapter 1, business analysis. So first off, you've got these three main segments, right? Institutional Securities, wealth management, and investment management.
Exactly. And here's where it gets really interesting strategically. For the year ending December 31st, 2024, wealth management actually brought in more net revenue than institutional securities. We're talking $28.4 billion versus $28.1 billion out of, $61.8 billion total net revenues. Now, this wasn't an accident. It's the result of a very deliberate multi-year strategy to de-risk the firm. Think about those big acquisitions like E-Trade, Eaton Vance. They were all about shifting towards more stable, recurring, fee-based revenues, a big shift for them.
So wealth management's leading the charge now. What specific services are driving that? And you mentioned acquisitions like Solium. How did that actually feed new clients into the pipeline? Is it that smooth?
It's actually quite clever. So institutional securities, that's your classic investment banking stuff, capital raising, M&A advice, sales and trading, financing, you know the drill. But wealth management focuses on the financial planning, the advice, plus self-directed trading through E-Trade. And Solium, well, that integrates workplace stock plans. So Morgan Stanley manages stock plans for companies, and that builds relationships. Those employees often become individual wealth management clients down the line. It's a really effective pipeline, almost organic. And then investment management, that offers global strategies, different assets for institutions and individuals.
Okay, so they're definitely diversified. What does that mean in terms of their overall size and, market presence?
Well, their market position and scale is just immense. You've got a $251.3 billion market cap, over 80,000 employees, 1,200 offices, 43 countries. I mean, this isn't just big. It makes them a systemically important global financial institution. GSIB, right. Their main pitch to clients is this integrated ecosystem. A trusted expert partner, one single gateway to everything they offer, and that huge footprint. It lets them leverage scale in ways smaller firms they just can't.
Okay, let's zoom out a bit, the wider industry. What are the really big transformative trends you're seeing in financial services in 2025? Where's the action? And crucially, how does AI fit into Morgan Stanley's picture?
Yeah, the real action, and this ties directly to that AI question, it revolves around a few key things. Obviously, AI and automation. Then there's the ongoing digital transformation. Embedded finance is huge. The importance of scale, just getting bigger. And of course, ESG demands. This whole technology imperative is really speeding up. And Morgan Stanley's scale, that's a massive structural advantage in the AI race. They've got the money for huge investments, access to unbelievable amounts of proprietary data, and the brand to attract top AI people. It creates this powerful cycle, widening the gap between them and smaller players. That's how they're adapting to AI. It's baked into their scale.
Now, looking at the competitive landscape, Morgan Stanley's PE ratio, price to earnings, is about 18.04. Their market cap, $251 billion. That puts them right there with Goldman Sachs, PE, around 17.34. But maybe a bit richer than JP Morgan, Bank of America, Citigroup, which are more in the 14-15 PE range. But that pivot to wealth management really makes Morgan Stanley's investment profile different, doesn't it? especially compared to Goldman's trading focus.
Absolutely. It's a distinct profile. And all this competition happens within a pretty fragmented global regulatory environment in 2025. Regulators everywhere are zeroed in on operational resilience, consumer protection, AML/CTF, anti-money laundering, counterterrorism financing, and now ethical AI. We might see some deregulation talk in the US, maybe, but the core focus on risk management, financial stability, that's not going away. Just navigating all these global rules is incredibly complex, a huge hurdle.
Speaking of hurdles,
Yeah.
what about barriers to entry? It must be incredibly tough for anyone new to break into this space.
Oh, absolutely immense. Just think about the regulatory and compliance costs. They're staggering. Then you need massive amounts of capital, like under Basel III rules. But maybe even bigger than that is the brand and reputation. Morgan Stanley has spent 90 years building that name. You just can't replicate that quickly. In this case, that long legacy, it's a huge advantage, a massive barrier.
So putting it all together, where's Morgan Stanley's competitive mode? What really defends their position?
Well, first, that brand strength and recognition is huge. That first-class business in a first-class way mantra, it's not just talk. It attracts top clients, top talent. It builds deep trust. That's a moat you can't just buy.
And that's backed up by some tangible things too, right? Costs, scale.
Precisely. They have significant cost advantages and economies of scale. All those high fixed costs for the best tech, for compliance, for that global network, they get spread across a massive revenue base. Their cost per transaction, per client, is lower than smaller firms.
Plus, clients tend to stick around, don't they?
Exactly right. They've built up strong network effects and switching costs, especially in wealth management and prime brokerage. Those deep relationships, the complexity of moving your financial life or major brokerage services, it makes clients very sticky, hard to lure away.
And are there any sort of unique assets that tie this all together?
Yeah, two really stand out, I think. First is their integrated model. It creates powerful synergies between the different parts of the business. Like those workplace services bring in employees who become wealth clients who maybe down the road need Morgan Stanley for an IPO. It all connects. Second is that strategic partnership with Mitsubishi UFJ Financial Group, MUFG. They own what? 23.38%. That's a stable capital anchor. Plus, it gives them incredible access to Asian markets. That's huge. The key thing here is that these aren't just separate advantages. They feed into each other, creating this self-reinforcing system that just keeps widening their competitive moat. It makes their leadership position stronger over time.
Okay, let's move on. Chapter 2, management evaluation. We need to look at the leadership. Ted Pick is the chairman and CEO. He's a 35-year veteran. Took over as CEO in January 2024, added the chairman role in January 25. What's his story?
Well, his management track record and particularly his crisis response history are really impressive. He played a key role raising capital back in the 2008 crisis, essentially helped save the firm. And then he engineered that big turnaround in the fixed income division back in 2015. He's seen as a sort of battle-tested fixer. That kind of experience is incredibly valuable, especially now, given all the uncertainty out there. He's the guy you want in charge when things get rocky.
And how about communication, transparency, ethical reputation? He seems to talk a lot about AI and collaboration. The firm has its code of conduct. But we did see that recent $2 million settlement, didn't we? About an exec selling First Republic stock on non-public info. Morgan Stanley didn't admit wrongdoing, but still.
Right. And that's a good reminder. Even with strong leadership and codes of conduct, compliance risk is just inherent in this business. It's always there. Shifting gears to capital allocation, their strategy, driven by this firm's strategy and execution group, seems really focused. Those acquisitions, E-Trade, Eaton Vance, Solium, they weren't just random grabs. They were clearly designed to speed up that pivot to the stabler, fee-based businesses. It fits right into that de-risking strategy we talked about.
And investors probably like their approach to shareholder returns, too.
Oh, definitely. They have a very strong share buyback history and a really consistent dividend policy. Think about it. 13 straight years of dividend increases. It's currently $1 per quarter, so $4 a year. And the payout ratio is sustainable, around 43.2%. That shows real confidence from management and a commitment to returning cash to shareholders.
So how are these big strategic moves actually translating into return on invested capital?
Yeah.
The ROIC.
It's getting better, which is important. ROIC was 2.47% for 2024. That's up from 1.78% the year before. But it's still below where it was in 2021 when it peaked at 3.10%. So the critical point here, the takeaway for investors is this. For that whole strategic pivot to really pay off, Management has to show they can consistently generate an ROIC above the firm's cost of capital, their WACC. The next few years are really crucial. You need to watch that ROIC metric very closely. It tells you if the new strategy is actually creating enough value.
All right, we've got the qualitative picture. Now let's dive into the hard numbers. We're moving into Chapter 3, Financial Analysis. As of September 18th, 2025, market cap is sitting around $251.3 billion.
Right. And looking at revenue growth trends, they've shown a pretty strong, though definitely cyclical path. The 5-year compound annual growth rate, CAGR, is a healthy 8.2%. But you can really see the cycles in the annual numbers revenue dips. When markets are tough, then it bounces back strong, like $53 billion in 22 and 23, then back over $61 billion in 24. It shows they're resilient, but still exposed to market swings, even with that strategic shift.
And profit margins look pretty solid.
Yeah, very solid. Morgan Stanley is clearly a highly profitable operation. Gross margin was consistently high, 93.3% in 2024. Operating margin, TTM, trailing 12 months, is strong at 31.36%. And net profit margin, impressive, 21.38% last quarter, 20.73% for the full year 2024. Those are really strong margins.
But I noticed their free cash flow. It jumps around a lot. Sometimes it's even negative. How should we think about that for a bank?
That's a really crucial point, and it's where typical metrics don't quite work for financial firms. Their FCF is, extremely volatile. It was negative $2.1 billion in 2024, for example. Trying to apply a standard FCF definition to a bank doesn't really make sense because their cash flow is so tied up in balance sheet stuff like deposits and loans. That's exactly why a normal discounted cash flow, or DCF, model, it's generally not the right tool here. A dividend discount model, a DDM, makes much more sense for valuation. It focuses on the dividends they consistently pay out, reflecting their profitability and capital returns.
Okay, moving to financial stability. Earnings consistency looks pretty good over the last decade, right? An upward trend, even with those bumps.
Yeah, EPS has generally trended up from like $2.90 in 2015 to nearly $8 in 2024, though it dipped in 23. It shows growing profitability and an ability to navigate different cycles. And similarly, that debt-to-equity ratio, around 3.45 in 2024, maybe approaching 4.0 recently. That looks high for a normal company, but it's just part of the banking model using leverage, and it's been pretty stable for them. It's also why the current ratio, always below 1.0, isn't really useful. Banks have customer deposits as liabilities. Regulators use different liquidity measures.
And we keep coming back to it, but that dividend stability and growth seems key. 13 years of increases, sustainable payout.
It's a major positive, which brings us right to the core of our valuation analysis. If you look at relative valuation, that PE of 18.04, it's similar to Goldman, but definitely a premium compared to JP Morgan or Bank of America. Maybe the market is rewarding that shift to wealth management, giving them a higher multiple for stability.
But for intrinsic valuation, you said we should use the dividend discount model because they're mature, stable, pay dividends.
Exactly. The DDM tries to figure out what the stock's worth based on all its future expected dividend payments, discounted back to today. It's a good fit here.
Okay, drum roll. What does the educational DDM model estimate the value range to be?
All right, based on our model, the estimated value range comes out between $70 and $90 per share.
Wow. Okay, that's a big difference from today's price of $157.41. What does a gap like that tell us about market expectations, maybe even risk?
It tells us quite a bit, actually. Now, remember, our DDM model uses assumptions to get to that $70-$90 range. It's important to know what they are. We start with the current dividend, $4. We project it growing at, say, 9% for the next 5 years, then settling into a long-term perpetual growth of maybe 2.5%, and we discount those future dividends back using a discount rate of 10.3%, which we get from the CAPM model, the capital asset pricing model, to estimate the required return. The fact that there's such a wide gap between that $70-$90 output and the current $157 price, it strongly suggests the market is pricing in much more optimistic assumptions. Higher growth, maybe for longer, or a lower discount rate. And that fundamentally points to a potential lack of margin of safety for anyone buying in now. There's less room for error if those rosy market assumptions don't quite pan out. It also shows how sensitive these models are, tweak the growth rate a bit, and the valuation changes significantly.
Okay, let's shift gears then. Chapter 4, Market Sentiment. How is the market actually feeling about Morgan Stanley right now? Looking at market perception, analyst targets, consensus ratings, it feels like cautious respect maybe. The consensus is a weak buy, but there are a lot of hold ratings in there, and the average one-year price target seems to be around $145 to $156. That's basically at or even below the current price of $157. So analysts aren't seeing much upside in the next year.
That's right. But what's interesting is the contrast with the recent news impact and the general media tone. That seems mostly positive, quite forward-looking. You hear a lot about AI's potential for them, their strategic moves in private credit and real estate, and, optimistic market calls from their own strategists often make headlines. There's a narrative of confidence.
And what about market indicators like short interest?
Well, short interest as a percentage of float is really low, just 1.21%. That's way below the peer average of around 3.20%. It suggests not many sophisticated investors are betting heavily against the stock right now.
And technically, price versus moving averages.
Looks strong there. The stock's trading comfortably above its 50-day moving average, which is around 146 sellers. And it's significantly above the 200-day, which is down near $131.50. So that indicates pretty solid short to medium-term momentum, and the long-term trend is clearly still up.
Okay, interesting mix of signals. Let's move on to Chapter 5, ownership structure. Who actually owns Morgan Stanley?
The top institutional ownership is dominated by one key player. Mitsubishi UFJ Financial Group, MUFG, they hold a massive 23.38% stake. That's not just a big holding, we called it a strategic anchor. It provides real capital stability and, crucially, access to those important Asian markets. After MUFG, you've got the usual big institutions, State Street, Vanguard, BlackRock, holding significant chunks like 6–7% each.
What about the insiders, the people running the show? Are they buying or selling?
Well, overall insider holdings are pretty low, just 0.2%. But the recent transactions are quite telling. Over the last 3 months, there's been a really notable trend of heavy insider selling. We counted 8 sales versus only 1 purchase. And a lot of that selling was by senior leaders back in July 2025, right after the stock had a strong run-up. That can often be a signal, that the people who know the company best might think the stock is fairly valued or maybe even a bit rich at current levels.
And beyond MUFG, is the ownership concentrated or spread out?
It's pretty diffuse, actually, which is quite typical for a company this size, a mega cap. The top 5 institutions together control about 45%, so no single entity besides MUFG has overwhelming control.
All right, now it's time to weigh the pros and cons. Chapter 6, risk assessment. Let's start with a classic SWOT analysis. Strengths, weaknesses, opportunities, threats.
Okay, strengths first. We've hit these, but they're crucial. Premier brand, that diversified business model they've built, significant economies of scale, and proven leadership with Ted Pick.
And the weaknesses.
Still some cyclical exposure to the markets, definitely. Operational complexity is a huge global firm. Things can go wrong, like that First Republic situation reminded us. And, well, high compensation costs. You got to pay top dollar for talent in this industry.
Okay, opportunities.
Artificial intelligence is a big one. Huge potential there. Global wealth growth, that's a massive long-term tailwind they're perfectly set up for. And maybe some strategic M&A possibilities if regulations ease up a bit.
And finally, the threats.
Intense competition, always. Regulatory flux, the rules can always change. And just general macroeconomic and geopolitical instability, that's always a risk for global finance.
Let's drill down on those macroeconomic factors. Inflation was still at 2.9% in August 25. But the big news, just yesterday, September 17th, the Fed cut interest rates for the first time this year, down to 4.00%, 4.25%. What does this easing cycle mean for Morgan Stanley?
Yeah, that Fed cut is huge. And for Morgan Stanley, it's really a double-edged sword, as they say. On the one hand, lower rates. That tends to stimulate the institutional securities side, more M&A activity, more IPOs, hopefully. That's good for investment banking fees. But on the other hand, it directly hits their net interest income, the NII, from all that client cash sitting in wealth management accounts. That's been a very profitable, growing area for them. So lower rates squeeze those margins. The big question is the net impact. Will the potential pickup in banking offset the hit to NII, and how quickly? It's a really delicate balance for their revenue mix right now, a key risk.
Okay, and what about geopolitical factors? Those U.S. tariffs announced back in April, 10% general, up to 60% on some goods. We saw the market react immediately, more volatility, S&P dropped, credit spreads widened. How does that directly impact Morgan Stanley?
Well, those tariffs create direct negative risks. You could see a slowdown in client activity, fewer cross-border M&A deals, maybe even more loan defaults if certain industries get hit hard. But, and this is where their model helps, it also provides a kind of partial hedge. Their sales and trading division can actually make money from increased market volatility, and they can offer hedging products to corporate clients trying to manage that tariff risk. So while it's definitely a negative overall, their diversified business provides some resilience against those kinds of global shocks.
All right, let's wrap this all up. Chapter 7, conclusion. Let's synthesize the findings. Start with a bull case. Why invest in Morgan Stanley?
The bull case is strong, you know. They've successfully transformed the business towards more stable wealth and investment management. They have that wide competitive moat brand scale integrated model. You've got proving leadership under Ted Pick, a clear commitment to shareholder returns through buybacks and dividends, and they're perfectly positioned for long-term trends like global wealth growth and AI adoption. It's a quality story.
Okay, but what about the bear case? The arguments against investing right now.
The bear case really centers on a few key things. First, valuation concerns. The stock's at 157 concerns, trading above analyst targets, and our DDM suggests it might be quite rich. Second, that significant insider selling is a red flag. Third, there's still inherent cyclicality in parts of the business. Fourth, those macroeconomic headwinds, especially falling rates hitting NII, are a real concern. And fifth, the geopolitical risks from things like tariffs add uncertainty.
So let's reiterate the valuation summary. Our educational dividend discount model gave us an intrinsic value estimate of
Between $70 and $90 per share.
and that big gap between the model value and the market price implies.
It implies the market is pricing in a very, very optimistic scenario. High growth, smooth sailing. It leaves very little margin of safety for new investors if things don't go perfectly according to that optimistic script.
So bring it all together for our concluding outlook.
Look, Morgan Stanley is absolutely a high-quality company, exceptionally well-managed, strong moat, great strategic positioning. That's not really in question.
No.
But the attractiveness of the stock at its current price, $157.41, that's much less certain. The investment case today really seems to hinge on near-flawless execution from management and successfully navigating some pretty significant macroeconomic and geopolitical headwinds.
So the final provocative thought for you, the listener, might be this. Given everything we've discussed, how much of a premium are you really willing to pay for that quality and proven management, especially when the valuation model suggests such a significant gap? Something to think about. And that brings us to the end of this deep dive on Morgan Stanley. We covered a ton of ground today. We really hope you found this discussion insightful. If you did, please do us a favor, hit that like button and subscribe to Stock Analytics AI right here on YouTube.
Yeah, and don't forget, members get priority access to our deep dives on S&P 500 stocks for just $4.99 a month. We're covering all of them over the next few months, so members get the inside track. Or if you just want a specific company covered, drop us a super thanks. We do take requests that way too. And the important reminder, please remember, this analysis was generated by an AI system. It's for educational purposes only. It should absolutely not be considered financial advice. Always, always do your own thorough research, or better yet, consult with a qualified financial advisor before making any investment decisions.